signing on to watch this each week, and I always make the presumption that, hey, everybody's watching this every week. Everybody that's been on there has already seen it. So I had a couple emails and they said, go a little slower through the timeline of opportunities. This is our economic mapping. So for those of you that have not attended, I'm going to go through this. And for those of you that attended, hey, it doesn't hurt to always see it again and just understand what this economic map is. And for those of you that have not attended, this is basically what every economist, every financial institution, every hedge fund manager does in any type of crisis or opportunity. They map out what the environment is, and then they create different algorithms. And much like in a Monte Carlo simulation, what they're doing is they're coming up with probabilities of outcome, and then that helps them make reasonable and logical decisions as opposed to informational decisions upon what the media is saying, or worse, emotional decisions. So let me first cover what happened back in February. We saw this virus start to surface back in January. February, it really hit us. What the institutions were doing is they were buying big data, and big data was telling us, the big institutions what was happening with the consumer sentiment. In other words, what fears were out there, what did they anticipate with closures, economic downturns, and the institutions started selling. That just creates a domino effect. When large institutions start to sell, then computer selling kicks in, because they usually say to sell after it goes down by some kind of percentage, which by the way is why we don't ever do that. We don't ever want to be caught on what we call that flash crash. And then what happens is when those computer algorithms start to kick in and start to sell and pushes it even further down, then what happens is consumer fear. And media doesn't help, because when you go on media, they always have an answer. They'll say, well, that's because of the virus, that's because of this, that's because of that. They got to fill that short-term media fill and tell people what they think that day is why it's happening, versus, hey, these are all these economic factors coming together and there may be no reason to sell at all. So consumer selling jumped in. We knew that the virus levels were crazy in March and part of April. They started to level out here in June. We have 5 states right now that have actually had a net increase. Now again, when we talk about net increases, let's look at how the financial institutions skew the numbers. You know, I'll never forget this. The first market crash that I went through was back in 1987. And in 1988 and 1989, what was happening was a lot of the mutual fund companies were coming out and they were saying, hey, look at what we did. We made 30% rate of return. Aren't we smart? Aren't we wonderful? Well, listen, if a market goes down by 50% and then it just returns to its norm, right? Just returns to its norm. If the investment company that gives you that calculation is starting at the bottom of the market, they could legally come out and say they made 100% rate of return, right? Because if you have $100, it goes down to $50, and then you start your calculation at $50. Well, you have to have 100% rate of return to get back to your original $100. So if your $50 goes back to the 100, if the investment company or manager or advisor says, I made 100% rate of return, well, technically they did if you look at the start date, right? And if you look at the overall date over a long rolling period of time, maybe they're back in that 7 or 8 or 9% average mean, right? But so it's no different with the virus. Look, there's a lot of information that I consume on a daily basis, and a lot of it, I would probably tell you what I consume on 2 to 4 hours of research every single day, 75% of it, and it's a huge number, is false. And I can tell you after 35 years of doing this, when I look back 30 years ago, there was probably about 5 to 10% of misinformation out there. Today, it's about 75% is misinformation. So when I'm reading something, I have to then go back and dig and find the statistics. So when you see virus cases on the upward trend, well, you got to look at where do they start that benchmark? Did they start the benchmark at its highest point and then it's 20% above its highest point? Or did it pull back by 20 or 30%? So, you know, we should start tracking the virus numbers because it's so closely correlated to the economy, just like we should have truth in numbers when we're tracking the stock market, right? It's got to be where that benchmark started. So if you had X number of cases and an X number of benchmark of virus cases within your state, and you decrease that by 25%, and then you start to see an increase in the reemployment and the deployment of people back into the environment, you can't scare the public in saying 25% increase in virus cases. No, it's not. It's a net, and they're doing the same misinformation with unemployment. Again, you gotta be careful with this information. You gotta first find out who's producing it, what is their incentive, and is it fact checked, is it correct, and then what are the calculations are that they're using. If you don't, you will find yourself in a absolute stressed out, world is coming to an end, Chicken Little, the sky's falling environment. But when you really go back and you start tracking the accuracy of how to follow these numbers, it's not as bad as what the media would like it to make it, what they'd like it to be. Let me give you another example of that. We know that a lot of the hospitals and a lot of the states are crying to the federal government to say, give me money, give me money, give me money, because we're broke and we have to cover all these this virus cases. Here's the actual fact. On average, even the 5 highest hit states on occupancy of beds in hospitals are still only at about 10 to 12%. We're talking the highest. We're not talking about a pandemic where there's no hospital beds. And we saw things back in March where people were lining up in hallways. We don't see that now. The government and even the states have done a fantastic job at mitigating these risks. We saw back then, back in March and April, the ventilators. Now there's so many excess ventilators, so many excess face masks that they're basically storing these things for future use. So again, I'm not concerned about another resurgence of the pandemic, because while it might have an economic change in how we feel comfortable in redeploying our money and going out and to socialize, it does not have a net negative effect on the ability for the hospitals to take care of these people or the employment of the first responders. Now again, what I'm saying is in general, in terms, there are certain locations that are still hot spots. We know that. We see that New York City is under control, but we saw that as a broken chain, a broken link in the chain. So what I'm saying is categorically overall, the country, the United States, is in a really good position in this war against the virus, because now we've got better control of our healthcare system, our first responders, and now I'm going to talk about a few things that will offset that in the short term. But in my original economic mapping, you saw that I said towards the end of March and then towards the end of May or June. As you can see, let me just find a little highlighter here, and if you're watching this, let me see if I can find this. There we go. Okay, you can see down here, I said here we're going to reopen some of these businesses. That's right on track with what we estimated. And then what I said is that later on what we would see is we would see a leveling out of the unemployment. And that has actually happened already. We are starting to see a net increase or a leveling, depending on the last 3 weeks have been a little up or down, but I'm going to take that as a leveling out effect. And we're now seeing the reemployment or the re-socialization of our country. And we're starting to see a little bit of the spending spree. Now, you might see some of the news out there. I don't think we're anywhere near our spending spree capacity because people have been locked up. But we still are seeing some of this news about this resurgence of the virus. And looking some of the sediment and some of the research papers that are out there right now, we're still seeing at about 40% what they call saturation, meaning people are getting back to life. There's still 60% of people that are not. They're not going out to dinners, they're not going to movies, they're not going to the malls, they're not spending money. So that is a big problem. Now, as you can see in the blue, my estimate is that we're going to continue to see great volatility within the stock market. And that's going to happen all the way through from August through October. This was my original mapping, and I'm going to show you some adjustments that I just made just this week based upon some of the recent fundamentals and macroeconomic things that are happening in our country. Not global, but macro right here in the United States. And I estimated that somewhere towards October, November, we are going to see a big pullback in the stock market. This will happen because of institutions. This will happen because of computer trading. This will happen because of confidence. But it has nothing to do with what you'll see soon in this presentation, which is what I'm estimating in a 1 to 2 year, because I'm estimating that this market will take off in the first quarter of next year. And that is another there's a couple reasons for that I'm estimating. One is birth rates. Number two is resocialization or resaturation of the population. We're going to see that once the institutions get done playing their little games with, the average investor's emotions, we'll start to see some of that level out. But what I do see is I do see real estate continuing down. So right now, I've been getting all these emails about, Ken, I think you're wrong because there's this big surge in real estate. Look, the bottom line is you have 8 million people that have forbearance, and I'm going to cover that in a second. And we have not accounted for that because they have a 1-year buy on their mortgage payments. And you'll see in a second, FHA just extended their forbearance. But I'm estimating probably 30% on average that the stock or the real estate market will fall. But what that will do is that will give the opportunity for a lot more people to buy homes. And I'm estimating towards the end of 2021, with the increase in employment and the increase in birth rates, that we are going to see a stock market that's we haven't seen before in history since 1929 increases. And we're going to start to see a huge increase in real estate because of the shortage and the affordability. That means that there's some opportunities that are laying out there. Now, again, I'm going to put this giant warning out there. Listen, I've made these warnings in the past, and in a sense, it saddens me because I'll get people that'll argue with that and say, well, no, because I remember this. I remember back in the tech days, 1996, 1997, people were making 20-25% on their money every single year. You literally could close your eyes, throw your money at a dartboard, anywhere it landed, you were making 20-25%. And it was unsustainable. I mean, you had PE ratios that were off the map, and there was no foundation for those earnings. And so people would say, well, it's a new world. Technology is a new world. Well, let me just remind everybody that, the NASDAQ going into the tech crash in 99 was around 5,000 points. It went down by 50%. And look, it took them 15 years to recover. Right now, you've got a NASDAQ that has recovered, and it's almost doubled, right? So the entire tech side of the market. But it took a long time to do it. And that's one of the reasons why we design portfolios in the bucket strategy, the 1 to 5, 5 to 10, 10 plus strategy, is to take advantage of that long-term potential of higher growth, but accepting the volatility. And I really believe that that's what we're going to see again. So the beauty of that system is if you've got it designed correctly, and let me throw a little disclosure in here, I'm not talking about building your buckets with annuities, right? I did a whole broadcast on that. You can check it out on the YouTube channel. The annuity landscape has changed, but I know there's annuity insurance agents still out there selling those things. I'm talking about equities, bonds, and real estate and building that out. But my biggest fear is what you can see here going into 2022 is going to be the tax changes. And what I'm going to tell you today is that the longer we see this civil unrest, the longer that we see the prevention of people trying to protect themselves, which will then delay the saturation of society, we are going to see we're going to probably see an upset in the election in November. And I am warning you now that if the Democrats get in, they've already proposed elimination of estate tax exemptions. They're looking at raising corporate income taxes back to 35%, which will create just a horrible competitive situation on a worldwide platform for corporations. It will decrease the amount of profitability, and that means it will decrease the amount of potential in the stock market growth. You're going to see, my estimate is, and I'll state this here again because I did it in 99, I did it in 2005 and 6, and I'll state it factually right here. We're going to return to 1970 tax rates where taxes were, on average, brackets were in the 60 to 70%, depending upon how much you were earning. So if there's one thing I'm fearful of, It is not the stock market. It is not the real estate market. My bogey at this point is the election and the taxes that will have to happen. Now look, it doesn't matter who gets in, what side of the aisle gets in. If the left gets in, what's going to happen is that we're going to see probably doubling, if not tripling, of tax rates, because it's not going to be to just pay down the debt that we accumulated with this $7 trillion of relief. But if the right gets in, listen, I'm not telling you that the right is going to be able to forego any kind of taxes. It doesn't matter. I just think that the left is going to just wallop the middle class. They're going to go after the upper class. But listen, it's always been my experience that the wealthier people will always avoid taxes because they have experts to help them do that. So while there's intention there to lower the taxes, it usually hits the middle class. It does. And middle class today are those people sitting on, assets in retirement between $1 and $5 million. They're not super wealthy. That's what they need to survive. And I think they're going to go after IRAs. I think that they're going to go after Social Security. So again, what I'm looking at and suggesting here is that you be very careful with the way that you're planning out your taxes, and that you have a really good, solid tax plan. If there's any year to ever pay taxes, it's probably going to be this year and maybe next year. So again, think of really creating a tax plan, and don't shy away from paying taxes. Listen, if you you go to the store and you got to buy something for $100, if they tell you today there's a 30% discount on it, and you know you're going to need it, you buy it. You save the 30%. What I find is just amazing is that people out there will know that they're going to pay more in tax in the future. And they know that they can just take the money now and pay the tax now at the lowest rate we've ever been in history, yet they'll let the emotional block just come in and go, I don't want to pay tax. It's not, listen, you got to get over that, whoever you are. If you're that kind of person, I know I'm talking to a lot of logical, mathematical people that just do the right thing, but a lot of you out there are sitting there going, yeah, but I just don't want to pay the tax now. Pay it! My goodness gracious. You have no idea what's in store when you can see these numbers behind the scenes that I'm looking at what our taxes are going to be in about 2 years from now. But in that period of time between now and the end of the year, we're going to see some market volatility. All right, let's get into the facts and figures. Unemployment, Fed decisions, interest rates, housing, inflation, and stock market indexes. Let's cover each one of these. We have unemployment. All right, so we got 1.5 million workers claimed unemployment against an estimated 1.3 in the last week. Now listen, that's 58,000 less than the week before. It doesn't matter what somebody estimated, the net number is still 58,000. There is a net 13.3% in May unemployed versus 14.7% in April. We are leveling, as what my economic map said, the estimate of 65% deployment. What does this mean? What I mean by this is, and I've been talking about this now for going on 3.5 months. We saw this in the tech crash, right? Because tech companies laid off. So what did people do? They had to deploy their skills in different areas. Listen, I was around way back in the early 80s when steel mills started closing. I was in New York and I was practicing in New York. Steel mills started closing. Auto manufacturers were going to Mexico and Canada. And this was the whole introduction of NAFTA, which I believe destroyed our economy. It just nailed us right in the neck. We had to turn into a service-based employee instead of just creating incentives to stay competitive in the world manufacturing and hard materials area. So what happened is in every one of those crashes, even going up into the 2008 crash, even the 2011, the terrorist act, that even had a change in this redeployment. What this means is, let's say that you're going to see this in a second, let's say that you're in the hotel business, and hotels take 5 years to get back, and they're not going to hire you back. What are you going to do? Well, you're either going to have to go back to school, you're going to have to go work in another job but in a different industry, hopefully at the same pay rate, or you're going to have to redeploy your skills. And when we see these kind of economic downturns, we don't see a snap your fingers and you're back into the same industry as you were in before at the same pay rate. It doesn't happen. It's never happened, even in the 1929 crash. What happened was all these millions of employees were out of work, and Roosevelt stepped in and created the country's work program where they built the roads, they rebuilt parks, they rebuilt museums, they rebuilt everything, right? That was the biggest improvement to our country, which even made us more competitive because we had intrastate travel, we had intrastate commerce, we had railroads, everything was improved. Railroads, right? Big trucks were now able to cross where they were never able to cross before. But people had to go and work. They might have been an accountant, right? But now they had to go work on a road crew with an axe and a pick. And they did that to get through that period of time. But then there was other people that just redeployed their services by saying, I'm not going to go work on the road. What I'm going to do is I'm going to figure out maybe how to sell the axes and sell the picks and sell road machinery, right? And so they redeployed. Then we saw this again in the 80s. I saw this where the steel mills closed down, the automobile industry closed down. And then those automobile manufacturing plants that were still around, right? We had a lot that opened up in Tennessee, Kentucky, Ohio, in the middle of America. And then what happened is the robots came into play, right? So once we got through with the whole NAFTA and we got through with the distribution into other countries, Mexico and Canada, then the robots entered, right? And the robots, when they entered in the 90s, then everybody started getting freaked out. All the auto workers, steel workers, unions would cry and they fight and they say, we're against this. Well, listen, unions, you got to get on the board. Help your people redeploy. Don't fight the system. That's the biggest problem I've seen with unions, is they fight it instead of just saying, hey, this is the way we're going. What can we do to actually be a part of this profit? Not all unions, but this is what I saw a lot of in New York. And so we saw the auto worker that maybe was the riveter on the line, but now the robot comes in and he's the riveter, right? Replaces the human capital. And that worker had a choice. He could either go on unemployment, not go back to work. He could go, in some other industry. Or what he could do is he could redeploy by saying, maybe I need to learn how to sell a robot, fix a robot, program a robot, right? Whatever it is that you could redeploy. Well, as I said before, this never happens immediately. It takes time for this to happen. And this is going to take us, just like it did in 2008 and every other period, 2 to 4 years for this to happen. In the meantime, my estimate is that about 65% of those that are unemployed will go back to their regular job, but 20% over a 24-month period, it's going to take those people that have no chance to go back to their original job to redeploy to a different career or expertise. And then we're going to see what we've always saw. 10% will not adjust. So what's going to happen is when you're putting an unemployed person and they're making up to $1,000 a week, they're making more than what they were making when they went to work. So you got to take away that incentive. We saw that back in the 80s with welfare. When it was there was such a high incentive for people to stay on welfare, why go get a job, right? They're paying for your housing, they're paying with food stamps, they're paying for everything. And I can attest to that because I had a lot of rental properties and I had a lot of renters that were paying with Section 8 and they were physically, mentally capable of going to work. And someone would just say, why should I? Life is free, right? Why should I do that? I can hang out on the beach every day. So we got to stop this unemployment and make some changes to it. But the expectation is that unemployment will go from 6.5% down to from the 14% down to 6.5%, but that's versus 3.5%, which it was in February of 2020. All right, well, let's take a look at where the job losses actually are. And we see here, leisure and hospitality has the highest losses in people. Well, can they redeploy? Yes, they can redeploy. We see a lot of things where people are now selling backyard furniture. Backyard improvements is now the #1 selling item. Why? Because people are at home a lot more. Technology services, online leisure and hospitality things where people can direct them to RVs, campgrounds, beaches. There's all kinds of things that are going to readjust within that leisure and hospitality area. We have wholesale and retail, of course. Amazon, Walmart online, Target online. All these things have replaced a lot of the brick and mortar. So those people that are in the brick and mortar have actually lost, well, I should say certain retail, right? So certain retail like clothing, they've gotten killed. Whereas the online stores as well as the grocery stores like Walmart reemployed, 200,000 people, Target 100,000 people. Amazon originally hired 180,000 people, and they're going to estimate they need another 125,000 people. So there's a reallocation with that in that area. Now we're seeing a reallocation within education and health, right? So teledoctor on your app, instead of going in and seeing your doctor, there's going to be this huge industry that opens up. We're seeing it now with parents that have brought their kids home, and they get them out of the bullying, they get them out of the school violence, they get them out of the 1 to 40 child to teacher ratio. And they're now able to do homeschooling because the technology is actually there, that it's real. It's funny because when I heard of homeschooling, I always thought of, two like crunchy wilderness people living in an RV off the grid, and they're wearing sandals, and it's like the Woodstock kind of people, and they're homeschooling their kids. But today, hey, there's as many homeschoolers on the internet as there are kids that are going to school now because of the virus, and it's progressed because of the virus. Manufacturing, our government is fighting for it to get back here, but we got to do things with the unions. They've got to accept this, and they've got to help instead of fight, and they've got to balance out their profit incentive when a company makes money. We saw that with Ford, right? Ford came back last year, and they had, I don't know how many trillions of dollars it was, after they had already given their employees these huge pay raises and fought with them, and they made a profit there. The union is on the doorstep again. We want a part of that profit, and that's exactly why Warren Buffett said he never wants to invest in companies that have unions, because the minute they make a profit, the union is back at the door. It's got to be a balance, right? You gotta balance it out with what we're fighting for on an international commerce platform. Professional business services, not too hard hit, all the way down to information services. We've seen things like Facebook and Amazon and Netflix just kind of go off the map. So again, it's not devastation in every area, it's devastation in certain areas. So what are the critical factors affecting the stock markets? Well, if we get back to a 6.5% unemployment rate, it's going to be what the free spend per capita is going to be. What that means is after a person has their basic rent, their basic utilities, what are they going to be able to go out and spend? Meaning going out to dinner, movies, buying new cars, whatever it is. And a part of that is necessity, right? Because people just have to buy certain things. But the other part of that is leisure and just expenditures. That's a free spend. The free spend is really going to determine how well we saturate our population back into the economy. We've got to have tougher trade sanctions. I know people do not like the conflict with other countries, but the bottom line is, with prior presidents and prior administrations, we just got the snot knocked out of us for about 25, 30 years with the way that we were giving up a big portion. We were putting ourselves at such a great disadvantage. So the goal really would be to bring back manufacturing and pharmaceuticals. Hey, by the way, I'm not throwing stones at either side of the aisle. I'm talking all the way back to the Reagan years. It was both Democrats and Republicans let so many of these other countries just walk all over us. We don't need to do that. We have natural resources, human capital, technology resources. There is absolutely no reason. Anybody that studied velocity of money should absolutely know there is no reason that we have to give in to other countries to do this. By the way, especially China. I mean, how would you like it? You come up with an invention, you send it off to China, you do everything you can to intellectually protect it here and internationally, and some company in China just comes up with an exact same copy of what you've invented. They outsell you because they can underprice it, and all of your work and effort is gone. It's up in smoke. I mean, here we've got laws against somebody going in a movie theater and video recording a movie. You do federal prison time. Yet this goes on every single day with people inventing things. They put them on Amazon, and now even Amazon was accused of copying things that were on their actual platform and selling them for less. So the government's got to come down on that. And then the big one is November 2020 election. And then what I said before is the civil unrest. Look, hey, I think everybody should go out there and protest whatever they believe in. That's what makes our country great. But these criminals that are destroying people's lives by beating up and breaking down their businesses and lighting them up on fire and looting them, hey, that just makes people more nervous about going out and getting back into the population. And ultimately, it's just going to hurt everybody. It's going to hurt every single American that lives in this country because it's preventing our system from working. So protest, but just don't be a criminal, right? So continued governmental support following the 1929 crash. Assuming that the government continues to follow that 1929 crash playbook and they don't tighten monetary policy too soon, we could see one of the best 5 to 10 years that we've seen in our lifetime. So the Fed decisions. Well, the Feds are buying corporate bonds. They were originally going to buy ETFs, but they swayed away from that, thinking that that would artificially increase the actual market, the supply and demand, and the prices of those bonds. And they also had a hard time deciding what ETFs to actually invest into, because obviously then you're siding with one single company, which is picking up a management fee. So we have a big problem in the failure of the program of the Main Street lending. There's virtually no participating banks. So a lot of these small businesses that want to borrow money, they can't even find a bank to do it. Now, I really believe that once this is it just started, right, the Main Street lending, that once the Feds see the failures in this, they're going to incentivize the banks, just like they did with the PPP. They're going to incentivize the banks. They'll make the system more streamlined. They'll make it easier. So I'm expecting October to November, and that's going to be a big, big push back into our economy. More money coming back in, but it's not stimulus. It's not printing money. It's a loan, but everybody will make money on it. Again, back to velocity of money. The PPP still has $129 billion sitting there in unused funds. Well, I'm estimating that they're going to open up a second round of that PPP, and those people that were allowed to get it the first time can actually get it the second time based upon certain criteria, which will throw that $129 billion back into the economy. That's not even in the economy right now. Interest rates. Well, here's some changes. We do have some changes from last week. It's about the first time in about 4 or 5 weeks that I've seen any changes whatsoever. The average money market rates, they were at 0.25 to 0.5. I've just seen them drop like a rock to about 0.15 to 0.25. It's what I said before. Listen, we are anticipating massive deflation and then massive inflation. It's going to be like that B bounce. And when that happens, the last place in the world you want to be is cash, money markets, or CDs. Why? If you have 5, 6, 7% inflation, okay, now I got to get off on a rant because this just always blows my mind. So there's this thing, a term I coined many years ago when I had a radio show, and it's called phantom cost. And here's what it means. So let's say, you go out to your mailbox, and now I'm showing my age. You might just be logging on, right? But I'll give you this explanation like I did 20 years ago. You go out to your mailbox, you open up your mailbox, and there sits 2 statements, right? One statement is your stock statement, and one statement is your bank statement. So you pull out your stock statement in these kind of times, and you sit there and you go, oh gosh, I lost 8%, I lost 5%. See that mentality of I lost. Hey, I don't look at it like that. I look at it and go, hey man, that thing's down 8%. I can buy more at a discount, right? But majority of the retail investors, the consumer investors, sit there and go, I lost this much money. And then what they do is they open up their bank account. And let's say they have $100,000 in their bank account. Even though that thing is only paying maybe a 0.1%, they'll go, oh, I didn't lose any money. And look, on my $100,000, they paid me $10 this month, right? This is what happens every single day, which is why so many Americans fail to ever achieve financial success and security, basic security. So what's the problem with that? Well, let's say that we had this V-bounce in this inflation, and now you're sitting at 6% inflation, which means every single year it costs you 6% more to buy the same darn thing as what it did before, right? Well, let's say you're sitting there at 0.10%, right, a tenth of 1%. So your $100,000 is actually worth $94,000 the next year. The next year it's worth $88,000, right? It's going down in what you can spend the money on. Don't look at your statement as this is how much money I have. Look at your statement as this is how much I can buy right now, right? And so when you start to see these drops in interest rates, this is where you cannot sit on cash. And listen, I know some of you that are listening today are sitting on a lot of cash because there's still, right now, $4.7 trillion sitting in cash and money markets. Listen, that's 70% of what the government just issued in their $7 trillion stimulus/relief package. So I know a lot of people are sitting on the sidelines, and this is not the time to do it. So average CD rates just went down, right? 1 to 1.25% from 1.6% 3 weeks ago. Mortgage rates have gone down. So this really begs the question when the media states, oh, mortgage applications are up 15%. Well, the typicality is that when mortgage applications increase, they increase the rates to slow it down so that they can act, because people will still apply and then they can charge them a higher rate. Well, it's down almost 20 basis points from the week before. And so really that's based upon supply and demand. Well, here's some other news, and it's trending right where I expected it would trend. The FHA is going to extend foreclosure freezes until August 31st. Now, this is their second extension, and new home listings, new home building are at 3-month highs. Why? People were cooped up. They can get out, and the forbearance has not hit, right? So we have not experienced the results of 8 million homes that are in forbearance or foreclosure freeze. Listen, when those 8 million homes hits, we're going to see an excess supply. We're going to see the average to lower demand. And what's that function? It's going to affect the price. Well, inflation. Estimates of deflation will be larger than anticipated. I've made this as a one change. It hasn't really affected my economic mapping. It just affects the timing as to when I expect things to happen. Why did I make that change? Well, late state openings. Some of the states are still holding on to just ridiculous lockdowns. A non-adherence to social distancing. So I can blame the governors, but listen, I can also blame a lot of people. I mean, I see people just out there, they're not wearing face masks, they're just in crowds of people. The protests themselves are going to cause a massive increase in the virus, right? I'm not worried about that over long term economically. I'm worried about what it's going to do to people and their families and all the people that they infect. I'm going to worry about it because now you have hospital workers and doctors that are going to get infected because these people were just not responsible. You have lower than anticipated return to employment, and that's due to high unemployment insurance. And you have the civil unrest and protests. So from August 2020 to December 2020, I'm going to make a revised estimate of inflation. So I'm estimating now that we're going to see that deflation from August to December, and then it's going to just pop into inflation. Stock markets. Well, as a whole, the stock market is overpriced based upon current earnings. However, what we're seeing is a diversion. We're seeing a lot of stocks that are actually priced correctly, even though they drop 30 or 40%, but based upon their projected earnings, once we reemploy and saturate back the population, they're correctly priced. But then you've got some very overpriced things that are pre-pricing the future earnings, like Netflix, Amazon, Walmart, on and on. There's a list of about 60 companies that I track, and these are all overpriced to earn current earnings. But if you look at the resaturation, they're not overpriced. We're looking at 1 to 2 years out, right? So expectations of earning are either going to drive prices upward or downward. And we have short-term hedge funds, large institutions, and computer trading that are going to create short-term market volatility. So what actions do we take? Well, look, you got to understand, short-term volatility, ignore it. It has nothing to do with your long-term performance. Unless you're one of these crazy people out there that thinks you're going to game the market by day trading or options trading or future trading, good luck. Listen, if Ray Dalio can't do it, I'm sorry, I'll be blunt. Neither can you. Because if Ray Dalio has now $140 billion under management, and he has a $30 million per year research budget and knows when to trade, he's got over 100 traders. Sorry, that book on options trading, or that little online course that you just spent $15,000 to attend, or that slick seminar salesperson that says you can invest 10 grand to day trade your way to riches. Tell me how that works out. I've been around this game for so long. I've seen so many of these charlatans profess that you can do these things, and there's absolutely no proof that you can, or that you can do it sustainability. I have people that'll email me and they say, yeah, but Ken, I made like 300% last year. I said, call me in 3 years. No one ever does, because it'll all revert back to the mean, right? So long term, 1 to 2 years, it's going to depend upon the virus and the vaccine. But in 2 to 5 years, we're going to see one of the largest increases in the stock market that we have seen probably since the 1929 crash. Well, where do we stand with the market right now? Well, as you can see, last week, because of that Thursday drop, we were down 7.3, but we recovered some of that. We're now down year to date only 4.2%. Let me bring your attention right over here to 2018. In the end of 2018, the S&P lost 4.38. Was everybody freaking out then? No, they weren't freaking out and thinking the world was going to collapse. It was just one of the down years, which whenever you invest, this is the expectation. If you're that kind of person that goes, well, this is what I had on January 1st, and this is what I had on December 31st, and darn it, I lost money that year. Here's my suggestion. Get out of the stock market, really. Because if you're doing that, you have no understanding on how this whole game works. It never is point to point. You can't track what your rate of return is or an expectation of a rate of return from this date to this date. What you're looking at is a smoothing over a period of time, an averaging down of volatility, which is how the market should work. If you don't understand what I'm talking about, here's a great suggestion. Mary Buffett wrote a book called Buffettology. Mary Buffett, Buffettology. Buy that ebook or buy that Audible. Listen to that. I don't have enough time to explain it. You'll understand what Warren Buffett calls Mr. Market, the kid with the slinky on the stairs, why you don't buy certain investments. Great book. Can't recommend. I read that thing every single year just to remind myself of the sanity or the lack of sanity in the universe. So it will really help you with investing. So let's get back. Timeline of opportunities, right? So here we go. We've got everything worked out on the economic map. I don't see any changes. The only thing I see is maybe where at the beginning I estimated August to October in this area. I might push that out 30 days to 40 days, maybe 60 days at the worst. Still doesn't change where my end of year calculations are coming in. But if something does change, I will certainly keep you apprised of that. So summary of actions. Look to buy tips. Why? Take advantage of this V possibility within the inflationary market, June, July of this year. Refinance now. Please do not use forbearance. You will be excluded from any kind of refinance. And do not use a short-term mortgage. Don't be one of these people that says, well, I'm going to take a 10-year mortgage or 15-year mortgage. And I'll say, why do you want to do that? I just like to be debt-free. No, it's not being debt-free. It's being mathematically smart with your money. It's saying, hey, if my net cost of money is 3%, darn it, I'd like to lock that bank down for the longest period of time that I can, right? Because when else am I going to see 3% rate of interest rate? And look, the bottom line is if you can go buy investments that have an average rate of return of 5, 6, 7, 8%, you're doing to the bank what they usually do to you. So stretch out the mortgage as long as possible. If you're a real estate investor, be prepared for January, March of 2021. I'll tell you what, if I was thinking about becoming a realtor, I would do it right now. I think that the realtors in the next 2 years, they are going to be one of the most profitable, huge business because of the turnover. It's just going to be massive. Turn on your DRIPs, meaning your dividend reinvestment plans in your 10-year bucket. And review possibility of the use of an IRA withdrawal. If you're going to buy real estate, there's a good tax hedge going on that. Also, get a cash flow blueprint. Listen, if you're not a client of ours, well, if you're a client of ours, you already know everything's blueprinted out within your e-money plan. It's bucketized. You can see it. You can do the what-if scenarios, the stress testing. But the bottom line is, if you're not, get a cash flow blueprint if possible, and look at increasing the growth on your models. You know, when I say models, say a Model 1 is the most conservative model, say a Model 6 is the most aggressive model. Let's say you're sitting in a Model 2 or 3 right now. Look at increasing that over the next 12 to 24 months and do it under DCA, that's dollar cost averaging. So if I'm in a Model 2 and I want to eventually get to a Model 4, I'm not going to try to time the market and do it right now. What I'm going to do is maybe take 1/24th every month for the next 24 months and convert it from that Model 2 to that Model 4. This way I'm hedging against the risk, because some months when I convert it, I'm going to buy lower, and some months I'm going to buy higher. But eventually, once I'm into that new portfolio, I have a much more growth-oriented, more aggressive type portfolio, but I didn't take the risk of trying to time it when I'm going to switch it. Review both Roth conversions now, as taxes will be expected massively to go up in 2022. Again, get off of that whole idea of, I don't want to pay taxes now. Listen, pay taxes now. It's not a matter of when you, of what you are, how do I say this? Don't worry about paying the taxes. Just worry about what you pay when you pay the taxes. You're going to owe the taxes, so get a discount on it, right? If you can't, listen, nobody has a crystal ball, but if you can't line up these figures to know what's going to happen with taxes, you're like the ostrich sticking his head in the sand. It's going to happen. right? It's an inevitable fact because of this $7 trillion. It has to go up. Get a tax plan. The biggest risk is the election. And finally, make sure, please make sure you get your trust updated. If you're a client of ours, we've released our trust amendment package, so you can contact us. If you're a client where we're managing assets for, you might be eligible for a discount on that. But this way you get all of your trust updated for the new Secure Act that went into effect January of 2020. What I'm talking about primarily is your trust needs to get updated because the conduit language, the IRA conduit language, conflicts with the new law, and it could cause an entire tax explosion within your IRA to your heirs. And you could fix it, but you got to change the trust. Hey, lastly, before I wrap it up, if you want to find out more information about what's going on, just jump onto our YouTube channel. You can hit the red button there on the right-hand side and subscribe. The way you find that is just Google H&H Retirement Channel on YouTube. You can find it that way. I'm sure a little searching you can find it. It's pretty easy. If you have any questions or things that you'd like to discuss with any of our advisors, you can also call us at 844-702-1040, or you can go to one of our other websites, which is our tax website, which is hhtba.net. That's hhtba.net. Hey, it's been a great week. We're seeing some positivity. Stay safe. Please wear your face mask. Keep your social distancing. You're contributing to the economic increase in our economy, and you're saving lives. Have a great week.